Now I have to welcome Ketoki Basu, who's the founder of Ketoki Basu and Associates. She's an extremely experienced professional from the world of finance, has worked with a lot of large corporations, younger, smaller companies, and she will talk to us today about understanding financial statements, which is basically the lifeblood of every business. It is critical that we know about where the money is coming from, where it's going, how do we treat it, and we must have a basic understanding of numbers, particularly financial statements. And to walk us through all of that is Ketoki Basu. So welcome, Ketoki, to the nice Aarohana session this evening.
Hello. Hello, everybody.
Hello. So
Happy
welcome,
to be
Ketoki.
here.
Can you hear me?
Hello. Yes, I can.
Yeah.
I said hello and happy to be here.
Yes, a warm welcome to you from a nice Aarohana. And for the audience, you will notice that we have put out a message in the chat box that provides you a link, a Google Drive link, which contains some spreadsheet templates that Ketoki has sent us, which we had already emailed to you as well as sent out on the Google Calendar invite. For those of you who had not probably received it or had the time to go through it, please click on that link right away. So you keep the documents open and ready as Ketoki goes through her presentation and introduces all of us to the idea of what exactly are financial statements and how we understand them. And these spreadsheets will help us understand what she's referring to. So over to you, Ketoki.
Thank you. Thank you. I'll just start. I'll just start sharing my screen.
Yes, please.
Yeah. So can you see my screen?
Yes.
Okay, so happy to be here with NICE. And so today now we'll be discussing about financial statements. Now, as entrepreneurs, all of you will be having somebody to prepare your financial statement. But nevertheless, you should have a basic understanding of finance and also to be able to question what is being prepared for you. So at the end of this session, we'll be having some Q&A session, so you can keep your questions ready. I'm hoping by the end of this session, you will be in a position to be able to estimate what kind of money you need to start, say, an activity. Assuming all of you have started a business, so what would you need to do within the business to start an activity? When you need to procure funds, and when does a business really become profitable? Be able to control your expenses, and also you have a fair understanding of business plans. Now, financial statements is all about where the money came from, where's the money now, and where did the money go. So when you look at the templates that have been given to you, just keep it handy with you because I'll be referring to it from time to time. So basically, financial statements today include these 6 things, which is profit and loss, balance sheet, statement of equity, cash flow, notes, and comparative information. But today we are not getting into all of them, but our emphasis will be basically on the 3 highlighted ones, that is profit and loss, balance sheet, and cash flow. This is just a basic awareness of what financial statements are and what it contains. Now, if you look at the financial statements that have been given to you, you will see that it is basically talks about some line item and a figure. Now, that figure doesn't mean anything to you. It's just a figure. So now if you want to know what that figure contains, you will have to go to what is called the notes. And the notes will give you the details of what that figure consists of. Now, financial statements, the regulatory authorities can want it for a month, they can want it for a year or 5 years or whatever. But internally, you can even prepare it for 15 days or 7 days. It's basically, you prepare it to keep a control. You can keep it for a monthly preparation as well. So the period is something internally you can define what you want to have. Now, there is something called accounting standards. Now, what is accounting standard? And see, accounting standard is basically a rule. Now, just like we have, when you prepare a financial statement, now each one will be accounting a particular transaction in a different way. Let me take an example. Let's say in case of a hotel. Now, a hotel's income can be either from food and beverage, or it can be from room occupancy. They can have other lines of business as well. Now, let's say these are the two main businesses of the hotel. Now, suppose you are going to stay in a hotel and you're a corporate customer. So you don't actually pay when you leave the hotel, but your company will pay the hotel after, say, a month, which is the arrangement that they have. Now, when will the hotel book sales? Will it be when you book the hotel? Will it be when you check into the hotel? Will it be when you leave the hotel after you've stayed there? Or is it going to be when your company actually pays the hotel? So these are various points at which sales can be recorded. But if each one were to record it in different ways, then we couldn't really compare one financial statement of one hotel with another, because two of them would be speaking two different things. So that is where you have accounting standards. So an accounting standard would basically tell you that if X, Y, Z conditions are fulfilled, that is the stage at which you can really record sales. So just like sales, you have these for expenses as well. So it just kind of gives a uniformity in a way in which financial statements are prepared. Now, when these financial statements are prepared, this is looked at by different stakeholders. But when different stakeholders look at these statements, each one of them looks at it differently. Now, to give you an example, for instance, government. Government would be more interested to see how much sales you made and whether you paid your GST or not. And have you made a profit? Did you pay your income tax? That is government's intention, to see whether the taxes have been paid. An employee may look at it differently. An employee's interest is to see whether the company is growing, whether it has enough money, how sure is he or she in the company, should he start looking for a new job? So an employee's intention is different. Similar way, your supplier and customer would look at it differently. Now, you would have seen financial statements. If you go to listed companies' financial statements can be downloaded. And if you go to something called investor relations, you can find their financial statements there. Now, you may have seen something called audited and unaudited. So what does this mean? Audited statements are statements which have been checked by a chartered accountant who's in practice, and he has certified that the financial statements give a true and fair picture of the company. So if you look at an audited statement of a company, you can more or less rely on the figures, and you can say that it gives the true picture of its financial results. Now, the first statement that we'll discuss is the profit and loss statement. Now, profit and loss follows a very simple equation, that is revenue minus expenses. So if revenue exceeds expenses, you have a surplus or a gain or a profit. And if your expenses exceed your revenue, then there's a deficit or a loss. So essentially, the profit and loss statement tells you about the profitability of the business. Now, when you look at the top part of the template of the profit and loss statement, you will see that it talks about income. So income has two things. One is revenue from operations and other income. Now, revenue from operations can either be core revenue or non-core revenue. So what's the difference? Now, core revenue is the main line of business. Now, I'm coming back to the hotel example. A hotel's core revenue would be from food and beverage, from room occupancy. Now, let's say the hotel starts to sell T-shirts or souvenirs, which has the hotel logo on it. So as a guest, you're free to buy that. But that's not the main revenue stream for the hotel, but it is revenue from operations. So it's the non-core revenue. Why I am talking about core and non-core revenue is that many of you may be startups who just started business, and it may be very difficult for you to cover your expenses initially. So what option do you have? One option is you reach out to an investor, and it may take you some time, but you may get funding. The second option is you have some property which you give as a collateral and you get a loan. You can also look at non-core revenue. That is, you start doing something before you can have your core revenue in place. And this non-core revenue will basically help you to cover your day-to-day expenses. And this non-core revenue is something you're going to discontinue later on, or it is going to become a small percentage of your total revenue from operations as your main core revenue picks up. And why I say this is because core revenue, to bring in core revenue for a startup, you require money, because your customer needs to know that you're there. So you have to reach out to your customer. To reach your customer, you need funds. So again, you come back to a situation where you have shortage of funds. So therefore, non-core may be a good way to cover your expenses initially. Now, other income is basically interest income, dividend income. Say you have surplus money and you invest it for higher returns, like simply a fixed deposit in a bank where you get higher interest rates. That is other income. The other interesting concept is GMV, or gross merchandise value, which you may have come across now. Now, gross merchandise value can be related to e-commerce, where the revenue from operations is basically the total amount that you bill to your customer. But that may not be your income, because you again have to pay for the product which you give to your customer. So you actually, in e-commerce, what is it doing? It's taking a product from somebody and sending it to the customer. So ultimately, it has to pay for the product. So the business income is not the top line or the revenue from operations, basically the commission. While regulatory authorities allow you to present your financials based on gross merchandise value, internally, you must be very clear that you have to work to increase your commission to be able to cover your expenses, and not get carried away by that my gross merchandise value is so high. Now, coming to the expenditure side of the profit and loss, there are different ways in which it can be classified. One of the ways of classification is based on how frequently that expenditure is incurred. A recurring expenditure normally features in the profit and loss account, and a non-recurring expenditure, which is called a capital expenditure, appears in the balance sheet. So what's the difference between the two? An example of a revenue expenditure would be, let's say you started business and you've just taken a room on rent. Now, let's say the room costs 20,000. Now, as long as you want to occupy that room, you have to pay for it. I mean, actual payment you may do at a month end or once in 6 months or once in 3 months. But essentially, if you don't pay for it, you don't get to occupy that room. So you're paying the benefit of that is on a day-to-day basis. So it's a recurring nature. A capital expenditure, on the other hand, is say that you started the business and you have, say, 10 employees, including yourself. So for 10 employees, you buy tables and chairs and say furniture worth 2 lakhs. Now for sitting 10 people, you don't need to spend on 2 lakhs of furniture every day. This 2 lakhs of furniture, let's say it lasts you for 10 years. So while capital expenditure in value will be a little higher, but it is something that doesn't occur every day. It is incurred and the benefit of that is felt for a longer period. Another way in which expenditure can be classified is based on control. So function, you can have 3 classifications, that is manufacturing, administration, and selling. So what is manufacturing expense? So manufacturing expense, since you are in the business of producing garments. So your manufacturing expense would consist of fabric cost, thread, needles, buttons, the people who are actually putting it together, the machine cost of stitching that garment. These are all directly related to producing your final product. So manufacturing expenses are directly proportional to the final product. It is variable in nature. So if your production goes up or goes down, manufacturing expenses go up and go down accordingly. The other expenses are administration and selling expenses. So example of administration expense is your rent expense, electricity, water, internet costs. And selling expenses would be the cost to send your finished product to your customer, the cost to reach out to your customer, to let your customer know you exist. These are selling expenses. And these will not increase in the same rate at which your production is going to increase, but it will increase, like if you spend, for instance, let's take the example of the rent again. Suppose your room rent is 20,000 a month. And in that room, you are able to produce 20,000 garments. That's the initial order that you have. So when you look at rent per garment, it is 1 rupee per garment. But when you have an order, say, of 40,000 garments, you don't need to take another room. You can continue to produce 40,000 garments in the same room. So therefore, it is more fixed in nature and doesn't increase in the same rate at which your production increases. So if you look at the variable expense or manufacturing expenses, they increase and decrease with production, whereas fixed expenses, they start reducing. So the 20,000 rent, when your production becomes 40,000, it becomes 50 paisa per garment, as against 1 rupee when it was 20,000. So if you look at, this is the expenditure part of the profit and loss account. This is typical template from a company, a large company. So I will just pick out few important things from these statements and explain it to you. So looking at employee benefit is basically costs related to employees, which is salary, bonus, incentives, staff welfare. What is staff welfare? Maybe tea, coffee. Other times, not now, not in current situations, but maybe you go for a team outing, you have a quarterly party, whatever that may be related to employees, to retain employees, that is staff welfare expenses. There's another item which is called depreciation. So what is depreciation? Now, depreciation is not a cash expense. Now here, I go back to the slide on revenue and capital item, which is a capital expenditure, which is non-recurring in nature. So coming back to the example where you have 10 employees, including yourself, and you spend 2 lakhs buying furniture, and that furniture you expect is going to last for 10 years. So now if a chartered accountant in practice would come and look at your financial statements and say whether it is giving a true and fair view. Now, if you expense out 2 lakhs in the year in which you bought it, you will be understating your profits because you're going to use this furniture for 10 years. So it's not going to give a true and fair picture. So typically what we do in accounting is that if an item is supposed to last for 10 years, we will expense out 1/10 of it every year. If 2 lakhs is the worth of furniture, 20,000 will be charged for 10 years. That is what is depreciation. So it is basically an accounting entry to show the value of the capital item has reduced and we haven't spent the full thing, but we're going to spend it over the next 10 years. So it is basically a charge to the accounts. Another important point which you will come across as entrepreneurs and as you go to raise money, investors will ask you this, what is break-even point? A break-even point really doesn't appear directly. You cannot directly get it from your financial statements, but you will have to recompute your profit and loss to calculate your break-even point. So break-even point is the point at which your profit or your loss is zero. That is, it is a point at which you recover all your costs. By costs, we mean both variable costs and fixed costs. So when variable costs and fixed costs is equal to your revenue, that is the point of break-even. Now, why do you need to know this? You need to know because you need to find out what is your break-even quantity. So break-even quantity is the fixed cost divided by the difference of 1 unit's selling price and 1 unit's variable cost. If you find the difference between a single unit's selling price and variable cost, and you divide fixed costs by that, you will get the break-even quantity. So that is the minimum quantity you have to produce or sell, not produce, to sell, to be able to recover your costs. So if you produce anything or you sell below this quantity, you incur a loss. And once you start selling beyond this quantity, that is the point at which you start making profits. Okay, so now we move on to the balance sheet. Now, before I move on to the balance sheet, if you look at the profit and loss, going back again, if you see the profit and loss, at the top it says, statement of profit and loss for the year ended March 31st. But so basically, profit and loss is of movement of transactions. It records the movement of transactions for a period, and then it gives the result. Balance sheet, on the other hand, after all these transactions have been incurred, what is it that you own from the business point of view, and what is it that you owe, and how much money has been given by the shareholders. That is also something the business owes to the shareholders. So you can refer to the balance sheet template. So asset is what the business owns, and equity and liability is what the business owes. The other important concept in balance sheet is basically current versus non-current. So normally this current and non-current is basically defined from your operating cycle, and normally we take it as 12 months. So any asset which is, so assets finally get converted into cash. So any asset which is not getting converted into cash in the next 12 months is a non-current asset, and an asset that gets converted into cash in the next 12 months is a current asset. So that is from the owning point of view. From owing, you have to give somebody anything that you have to pay in the next 12 months is a current liability. And something that you have to pay only after 12 months is a non-current liability. So this is the asset side of the balance sheet. Again, it has a lot of financial jargons, and I'm not going to get into explaining each one of them, because first of all, we don't have time, and this is just a basic session. So I will again pick out what is important and tell you. So non-current assets, again, you can have what is tangible and intangible. So what is tangible and intangible? Tangible asset is something which you own, which you can touch and feel. Example would be a furniture, it would be a computer, it could be an air conditioner in your office. So that's an example of a tangible asset. Intangible asset is software. And some other examples are goodwill, brand value, patents. Now, immediately we come to brand and goodwill, which I know many of you will be curious to know. That is, when you start a business, nobody knows you. You don't have a brand name. But after you've been there for, say, 5 years, 10 years, 2 years maybe, people can recall your brand. You have a goodwill in the market. Now, as per the laws, whatever is your internal goodwill, whatever your business has earned as goodwill, cannot be accounted in the books. That is never accounted in the book. That is called self-generated goodwill. Self-generated brand, self-generated goodwill does not appear in financial statements. If you see a goodwill or a brand appearing in a financial statement, in a balance sheet of a company, if you go through the notes of that year or previous years, you will know that that company bought another company. So if your company gets sold at any time, at that point when it is sold, your brand value or goodwill value will appear in the balance sheet of your acquirer. Another place where your brand or goodwill will appear is when you value your shares to bring in money. Okay, the third thing is depreciation and amortization. I already explained what is depreciation. Amortization is basically the same thing as depreciation, only that depreciation is the terminology we use for tangible assets, and amortization we use for intangible assets. The other thing is not current assets. So non-current assets, these are assets which will get converted into money when you sell it or convert it after 1 year. And current assets are those that get converted in within 1 year. So what are these? These are inventory. So suppose you're in the business of garments. Inventory can be fabric which you bought. It could be thread that you have bought. It could be at the point when you're preparing your balance sheet, it could be an unfinished garment, or it could be finished garments waiting to go to the customer, not sold. Finished product waiting to be sold. All this is part of inventory. But this inventory, the raw material at some point will become a finished product, and the finished product will go to the customer. So this is expected to happen within 12 months. It is not going to take that long. And it's not advisable also to make finished products and keep it for more than 12 months. So therefore, it gets converted into cash in less than 12 months. And therefore, it is a current asset. Trade receivable is a terminology we use for money that is due from the customer to you. So you have an arrangement whereby you give a final product to your customer, but the customer doesn't give you cash immediately. It is not cash on delivery always, but maybe the cash or the customer enjoys a credit period whereby he pays you after 1 month or 45 days, whatever arrangement you may have depending on your product. So till the time that the customer pays you, you have sold to your customer, so the transaction of the sale is over, but the customer is yet to pay you, so it appears as a trade receivable in your books. It is something money due to you, but it is lying with your customer. Deposit. Deposit is something that you have given, which is to come back to you at some point. For instance, if you take the room on rent, you would have given a deposit to the landlord. So when you leave that room and go somewhere else, the landlord has to refund that money to you. So it is again your asset. It is something you own. It is money you own. It is just not lying physically with you, but lying with someone else. So it is a current asset. And deposits can be both non-current and current. So if you have given your landlord a rent deposit, which is for a 3-year period, it would come in non-current assets. Whereas if you've given a deposit which is refundable within the next 12 months, it would come in the nature of a current asset. This is the liability side of the balance sheet, where you have the equity and the liability. Again, here I will pick out some things and explain it to you. First thing is the share capital. Now, share capital, all of you, those of you who have set up private limited companies or are having a share capital. So when you set up your company, you had 2 documents, which is called the Memorandum of Association and the Articles of Association. And you paid the Ministry of Corporate Affairs a certain amount of fees to have the authorized capital. Authorized capital is the permission that you have of the maximum capital that you can raise at one time. So you can. So suppose you've taken an authorized capital permission of 10 lakhs. It doesn't mean that you cannot have 1 crore capital later on. Yes, you can. It is only that you have to pay a fees, you have to take permission and increase your authorized capital. Now, after you've taken permission, say suppose you have an authorized capital of 10 lakhs, but you may not bring in money of 10 lakhs at one time. You may issue and it may get subscribed to the extent of say 5 lakhs. So that's the amount of share capital that has been paid up and taken, for which you have issued share certificates to the subscribers. Now, what are the types of share capital that you can have? So essentially, there are 2 types of share capital, equity and preference. So what's the difference? Equity shareholders are the true owners of the company. They are the ones who actually have voting rights in the company. And they are the ones who will get back their capital last if the business were to close down. Preference share capital, from the name, they have a preference over equity shareholders in 2 ways. One is a preference shareholder is entitled to get dividend before an equity shareholder gets. So if dividends are given by a company, the preference shareholder will first get the dividend and an equity shareholder will get it after that. But preference shareholders' dividend is a fixed amount of dividend. If you see a preference share, you will see it will have, it's prefixed by the percentage, 10%, 12% preference share, which means that that is the amount of dividend that preference share can have. It cannot have more than what is mentioned. Whereas equity shareholders can have any amount of dividend. Why they have such a high dividend is because they have a huge risk. There is no guarantee in getting dividend, and dividend they will get only when there's profits and after everyone has been paid. Also, if the business were doing badly and it were to be closed down, they are the ones who will get their money last. Now, preference shareholders normally do not have voting rights. Under certain circumstances, they are given voting rights, but for now, you can know that preference shareholders normally do not have voting rights. Other equity. Now, other equity earlier is to be classified as reserves and surplus. This is basically surplus that has come from your profit and loss account. So now if you have surplus from profit and loss account, you can have what is called retained earnings, or the opposite of retained is distribution. So suppose the business makes a profit. So what it can do is it can distribute the profits, and the distribution of profits is in the form of dividend. And if the business does not give dividend, then it retains the earnings. Why does it retain earnings? The reason a company retains earnings is it has growth opportunity. Let's say it needs the money for expansion, for a project, for a business, new venture in the business, so it retains the earnings. And also, other than that, I'll come to share premium a little later. From the profits, a company can create several other reserves and earmark it for various purposes. One such is general reserves. So there are many other reserves, and I'm not getting into the details of that. But what I will explain is share premium, because share premium is very important to you. Now, what is share premium account? So when you started your business, you created a memorandum of association and articles of association, and you as a promoter took few shares in the company. Let's say you took shares and the face value of the share, the rate at which you took a share was 100 rupees. That 100 rupees at which you took the shares, which is mentioned in your memorandum and articles of association, is the face value of the share. But you've been in business, say, for 2 years, or 1.5 years, or 5 years. And at that point, you need to take in more money. So an investor comes into your business. Now, an investor, if you have been having profits and your business has been doing well, you cannot bring in the investor at the same 100 rupees a share. At that time, your shares will be valued. And let's say at that point, the value of your share becomes 1,000 rupees. So you took a share at 100 rupees, but when an investor is coming in, his share value becomes 1,000 rupees. So when it becomes 1,000 rupees, 100 rupees goes into share capital, and the additional 900 rupees per share that you got from the investor comes into your share premium account. Now, the other thing is liabilities. Just like assets, liabilities can also be non-current and current. That is non-current, that is what you have to pay after 1 year. Example, a very common example of a non-current liability is a loan that you have, and the interest and the principal on the loan that you have to pay after 1 year is a non-current liability. But all interest and repayments that are due within the next 12 months comes under current liability. Other examples of current liability would be trade payable. Trade payable is something that you due to your suppliers. You could also have Let's say you don't pay your salaries at the end of the month, but for the month you paid at the beginning of the following month. In that case, if you were preparing a balance sheet at the end of the month, your employee salary dues would also come under current liability. So salary payable, then if you have any taxes due, income tax, GST paid, so payable, these would all come under current liabilities, which are going to be settled within the next 12 months. So again, here there is an important thing that you should know in as part of balance sheet is current, the difference between current assets, that is current assets are assets or things that you own which will get converted into cash in the next 12 months. If you take a difference between that and what you need to, what obligations you need to meet in the next 12 months, that difference is referred to as the working capital. And this is an example of a working capital cycle which is continuously moving in your organization. That is, you have money. That money you put into raw material. The raw material gets at some point is semi-finished and then it gets finished. After it's finished, it is sold to your customer. Your customer then pays you and you get money, which is again, income is realized. It is shown as sales, and then sales, of course, is booked the moment you bill it to your customer. And the cash that you get again goes into raw material. So now the difference between current assets and current liabilities. So current liabilities is something that you have to meet in the next 12 months. So it's very important that you ensure that you have adequate money at any point to cover your current liability. Actually, in a manufacturing business, it is said that you, on the safe side, you should have 2 times your current liability to meet your current assets. Because what happens is, current liabilities, as you see, customers are supposed to pay you. Inventory, which is supposed to be sold to the customer. Sometimes, if a customer delays in paying and there's a liability to be met, you should always have some safe margins to be able to meet your current liability. So essentially, working capital is the money that you need for your short-term requirement. It's very important to manage this very well, such that you always have money in the business. Now we come to the third and the last statement, which is the cash flow statement, which basically gives the movement of money during a period, during the same period. And cash flow statement is something very, very difficult to manipulate. You cannot manipulate cash flow. So if you really want to understand how a business is doing, I suggest that you look through their cash flow statement. So while you may see a company's sales going up, you may not see money coming into cash flow. That is, the customer may not be paying. That is an indication that probably the sales are not true. Anyhow, we come to the cash flow, which has 3 main parts. One is called the operating cash flow, investing, and the financing cash flow. So what do these basically contain? So operating cash flow comes out of your operations. So it is basically the profits from your business, which has to be adjusted for actual money coming in. And operating cash flow, when you initially start your business, when you're still trying to build your core revenue, shall I say, and build your customer base, trying to sell, it will be negative. And that is the time you're trying to raise money. But your model should be such that this money should help you to build your core revenue and become positive soon. Your operating cash flow becomes positive. Now, sometimes you may see that your profit and loss statement is showing a profit and your operating cash flow is negative. and you think, okay, whoever prepared this financial statement hasn't prepared it correctly. How can this be? I had a profit, and how is my operating cash flow negative? But this is always possible because profit and loss, let's say sales for instance, you've booked sales when you sold it to your customer, but you have a credit period with your customer, and so your customer hasn't still paid you, and so it hasn't appeared in your operating cash flow. On the other hand, if you have to, as a startup, you may not have that kind of a bargaining power with your supplier, and your supplier may not give you that long credit terms. So your supplier payment has gone out. Therefore, your operating cash flow is negative. Investing cash flow. So what is investing cash flow? So now you've reached a stage where you have surplus from operations. So you invest this. You can invest it in instruments which will give you higher returns. You can invest, so you can go for fixed deposits with the bank or any other investments. Or you can buy capital items, like you buy furniture, you start buying an air conditioner for your office, you start buying your own office, a building. So whenever you buy that, that goes out and is a negative figure, is investing cash flow. And when these are sold, that is, a computer becomes old, you're going to replace it, so you sell it, so there's money that comes in. So investing cash flow will show an inflow. Investments have matured, so it's an inflow. And the third part of the cash flow is financing. That is when you need money to finance your business. So where do you get it from? Either you get equity investment from an investor, or you get new loans. So when new loans come in, it's money coming into the business. So it's a financing inflow, cash flow, inflow of cash. And when you are repaying the loans, it is an outflow under financing cash flow. Now, I always suggest to all my clients at the initial stages, please monitor, and as entrepreneurs, please make sure that you have your cash flows on a monthly basis, at least at the initial stages, because when you have monthly cash flows, you know exactly how much you are spending. It may sometimes happen you have planned something, but you don't pay it that month, and it spills to the next month. So you have a bit of savings. Or it may happen that you didn't anticipate an expenditure and it has to be paid. Now, such things best monitored if you do it on a monthly basis, and then you review it at the end of every month to see what did you plan and what was the actual outlay, and then your planning becomes more and more accurate as you grow. And so it's also a way in which you are able to find out whether you missed out certain essential expenses. It will help you to understand what is your cash burn on a month-on-month basis. And the last, but one of the most important things in a cash flow or when you're doing business is statutory dues. Today, most statutory payments are online payments. Gone are those days where you could do any backdated filing or go and pay money. You cannot. And if statutory dues are not paid on time, the penalty and interest on that is heavy, and it is only going to increase the expenses of your business. It is going to have a negative impact on your business, because when a due diligence is done and an investor comes in, an investor would not like to put money into a business that has a lot of statutory outstandings and statutory dues were not paid. GST, for instance, if it is not paid on time, after a point in time, it gets locked. The portal gets locked and you cannot pay it. That doesn't mean you're relieved of GST. You still have to pay GST, but you got into a problem. So in the short time that was allotted to me, I hope I've been able to give you a basic understanding of financial statements, and I'm happy to take questions now.
Great. Thank you very much, Ketoki. That was very, very helpful, very, very useful. I think your detailed explanation of all the three important financial statements would have been very, very helpful. One question has come in from Vinay Venkat, who
Okay,
basically says that if a share with face value of 100 rupees is sold for 1,000, the 900 rupees gets into the share premium account.
right.
Now, if the share value crashes below 100, where does
Yeah.
this difference in value go?
See, this accounting is done at the time when the money is coming in. The crashing of the account is the value. See, for instance, this is the book value. There are two things. One is the book value and the market value. What you are referring to is the market value. The market value does not come in the books. So when the investor came in, he came in with 1,000 rupees and 100. So 900 gets accounted as share premium. Now, if the share price drops later on, it's basically the market price that has dropped, and that's not reflecting in your books.
I think that's an important point that everyone needs to know, that what is recorded in the books is never the market value, but what is quote unquote the cost, or the price as on the date of the transaction.
Exactly. And if you are interested, if you look at the book value of a company and you compare it with the market value, you will see the market value is way, way higher than the book value. It will always be if for a company that is really doing well.
Right. And you took the example of a restaurant in your examples. How will all of this change if I was to take a software or a manufacturing or any other business, where let's say there is some plant and machinery type in the case of a manufacturing entity? In software, there is nothing, it's basically people and some code that gets written.
So, what do you want to know in that aspect? The
Meaning,
costs?
how would these statements get recast? In other words, what are the
Okay.
items on the statements that I would need to review?
Okay, so now in case of manufacturing, really nothing would change because manufacturing has direct expenses in terms of manufacturing expenses and which are directly related to the product, machine, the people who work in the factory. These are all directly related and manufacturing expenses. But yes, in software, it would change. Software would really not have manufacturing expenses, and software is termed as a service. And so here, you wouldn't really have something called manufacturing expenses, but it is more the other administrative and selling expenses that would come in.
Right. And therefore, software in many cases is R&D that gets capitalized. Uh,
Yes, it can.
or you can treat it as a P&L item.
See, for instance, in software, suppose you're building a software which is going to be your product later on, or it's going to be your asset, then you can build it and you can capitalize it. So, capitalization cost would essentially be the time and the cost of the people who build the software, and maybe spares and parts, which is minor. So,
Right.
that's what gets capitalized.
Right. Uh, a question has come in from Avi. In cash flow statements, when you have cash from operations, what is other working capital items? Is there anything?
Yeah, see, for instance, working capital, if you recollect, is basically the difference between current assets and current liabilities. So, current assets is what your inventory, amounts due from your customer. So, it's really not cash. And similarly, your current liability is something which you owe, which you haven't really paid yet. So, if you take your profit, when you compute your operating cash flow, when you take your profit from the profit and loss item, it has to be adjusted for this working capital. That is the difference. For instance, if current asset goes up, it means that money hasn't come in, but money has gone out. And similarly, if current liability goes down, it means that money has gone out. So those
Yeah.
are the adjustments that have to be made to get my actual cash. So as I said, cash is very difficult to manipulate because it is actual movement of money in and out of the business.
Right. And one question again from Vinay. He says, when you calculate net worth,
Yes,
You again look at the book value and not the market value, right?
right, right. So
And
net, yeah.
yeah, sorry, no, please carry on.
Is there anything else to the question?
No, no, that was the question. Just
Okay.
wanted a
Yeah,
clarification.
so that's a good
Yeah,
question. I
yeah,
mean, that's a good question. I didn't touch on net worth because maybe I think it's a little more advanced. But
yes,
net worth is when you take the share capital value, plus if you remember other equity, in other equity, if you have not kept um, profits, if you have not kept profits aside for a specific purpose, then it is called as free reserves. So reserves which are usable by the equity investor. So that is the amount that goes into the net worth. So strictly speaking, see, when you start a business, you won't have any reserves in the first year. There's no profit. So all you have is your share capital, and say you took the shares at 100 rupees is the value of the share. But after 1 year, if you have made a profit and you didn't distribute the profit, you didn't give dividend, you retained all the profit. So that profit plus the total share capital that you have divided by the number of shares is basically your net worth or your true book value.
yeah, okay. A question on marketing from Bhavna Sharma. She says, marketing expenses.
Yes.
How should one account them? As a selling expense or anything else?
Yeah, it is part of selling expense
S and
because,
M.
yeah, it is part of selling and distribution expenses.
Right.
Yes.
Now, if you can, I think one of the important concepts that may be useful for people is really relating to working capital, because typically if someone goes to a bank, the first thing they ask like about working capital and basically current assets minus liabilities. Uh, if you can just take a couple of minutes to explain to the audience about that, what happens when current assets goes up and what happens when liabilities come down, what's the impact on working capital, because notionally if the creditors increase or if the debtors increase, right, what is the impact on working capital?
Right. Do you want me to open that slide? Would that be better?
Yeah, or you can just just talk
Okay.
about it. Yeah.
So, see, working capital management is very important. So, as I mentioned, working capital is current assets minus current liability. So, in order to, so you should basically have a positive figure of current assets minus current liability. So, as I said, typically in a manufacturing business, we try to see that you have 2 times the current assets. So, how do you manage this working capital? Management of working capital is that you make sure that you don't keep too much of inventory. Now, suppose you have to look at your operating cycle. Now, suppose you have a customer who walks in and asks for something. Typically, in case of garment, you need to keep some finished product such that the customer has a look at it. But you may be dealing in a product which is customized and made. So you don't keep inventory. In that case, the customer knows that yes, it will take from today after I order, it is going to take them about a month to produce it. So you're better off in those cases where you don't have too much of inventory. So what you should be doing is you should plan your inventory such that you see that you don't have too much of inventory and your inventory is moving. Now, as organizations grow, they have softwares to manage the inventory to see that the inventory is continuously moving. Manufacturing, it is very important because you may change your product, you may change your product design, and it can happen that a particular part that you were using doesn't get used anymore. It becomes obsolete, but it's lying in your inventory. And as a result, money is blocked there. So that time you have to take some action to make sure that you get rid of such inventory. So you should always make sure that your current assets are getting converted into money quickly and you have adequate money to meet your liabilities. Now, how do you make sure that your liabilities, the other way to do it is that you stretch your payables as much as you can, but that doesn't mean that you don't pay your suppliers on time, because if you don't pay your suppliers, again, you don't get your inventory, you don't get your raw materials. So that's how you need to balance it and manage it. So you need to continuously monitor it to see that you have a good working capital at any point. And banks, when you go for loans, they will basically look at this difference. What is your working capital ratio of your current assets to current liabilities before they decide to fund you?
Great. Thank you. Uh, Couple of last two questions. One is very quickly, if you can explain what does inventory turn mean, and
Okay.
the second question is there any software or any bookkeeping utility you would recommend that somebody running a small business can use? Questions have come in from Mamta Jain and Ravi Chivakula.
Okay, so the second question I'll answer first. I think Tally is the best thing to use at the
Tally
end
is
of
the
the
best. Yes.
best. Yes,
Okay.
it's the best. It's the most flexible.
Yeah.
And I've seen larger companies also, I mean, to a certain extent, with their operations are not too big to do Tally. But then as you have money and if you have inventory, try to get um, ERP in place, but that costs money. There are today small business ERPs also
So Tally
available.
is good enough for a small business.
Yes, Tally is good. They also have Tally ERP, which is good.
Got it. One.
Now, as far as inventory turnover is concerned, now inventory basically consists of three types of inventory. Inventory can be at three different stages. One is it could be at the raw material stage, it could be at a semi-finished stage, which is called a work in progress, or it could be a finished product. So all these inventories, so each of them, the turnover, you should see that it quickly gets converted. So in other words, when you have a finished product, the way it should not remain as a finished product for very long, but it should go to the customer. In terms of work in progress, it should get finished quickly into a finished product. And raw material should also get converted into work in progress and a finished product quickly. So you should not have, you should plan it in such a way, because inventory is something where money gets blocked up. And if you don't manage that properly, you have a lot of funds stuck there. I hope
Right.
I've been able to answer.
Great. So thank you very much, as we've just crossed our allotted time. So thank you very, very much indeed. This has been a wonderful exposition and an introduction to all the basic elements of understanding financial statements. Thank you. And I'm sure it's been very helpful to the audience, particularly all those who are getting familiar with these terms for the first time. Thank you very much, Ketoki, for taking the time to spend with us.
Thank
Thank
you very much. Thanks for inviting me, and it was a pleasure.
Yes.
Thank you.
And so now, yeah, we just have a couple of announcements before we wrap up today's session. So we've got an announcement again relating to the nice Aarohana business plan competition. It is India's first business plan competition for cultural entrepreneurs. I'd encourage all of you to please apply as well as to spread the word around. And the last date is the 26th of January. So please go to the website and go, which is the niceorg.in on the homepage, and you will see the link there. Please download the form and the deck and kindly apply for this. It's exciting. There's prize money. There's opportunity for mentorship, investor connects, as well as publicity and visibility for everyone. Right. So please do apply. And moving on, we've got our second last session on the 20th of January at 4 p.m. A member of our Industry Experts Council, Anchal Jain, was also the co-chair at the Cultural and Creative Business Program at IIM Ahmedabad, as well as a co-founder of Valmore Action Advisory, will be speaking about leadership. This is very, very important. It's critical that for all entrepreneurs who are essentially leaders to understand what it takes to build an organization, a team, and how to go about the whole process of creating a business and to lead a team of highly motivated people. So it will be Anchal Jain. Please do log in on the 20th at 4 p.m. and all the details are there on the flyer in front of you. Thank you all very much. Good evening. Good night.